Hi, I'm Ben Viemeister. I'm an analyst on the Osborne Partners investment team, and today I'll be discussing fixed income, looking back on 2022 and looking ahead to 2023. After a really rough 2022, we think calmer waters might be ahead for the asset class. So since the 1980s, investors were used to low volatility, declining yields, and that broke down pretty badly in 2022 as yields broke through that downtrend and led to the worst year ever for fixed income. Inflation was the culprit. Uh, Inflation had been a nice tight range for a decade plus, and that changed during COVID. You saw inflation surprises, which is in the green, those spiked higher. You saw core inflation in the red explode higher. And as a result, the Federal Reserve Bank declared war on inflation, and they ratcheted up interest rates, the Fed funds target, in the fastest tightening cycle in history. And that was done in the purple line right there. Now, the speed at which the Fed attacked inflation had a major impact on yields. And that's on the far right side of this chart. You see a huge increase from very low levels of 2020 through early 2022. And you saw an explosion higher. Now, short-term volatility, we think, often creates great long-term value creation opportunities. We saw that in spring of 2020, when amidst COVID, we increased the pace of our purchases of fixed income. We then took a pause from second half of 2020 through the first quarter of 2022, where we kept fixed income underweight because, as you can see in that circled area on the chart, yields were not compelling at all. And that changed in the second quarter of 2022, at which point we started increasing the pace of our fixed income purchases pretty quickly. Now that yields have reset to more attractive long-term levels, we are getting close to the end of the tightening phase of the monetary cycle and potentially entering the pause phase. Now, historically, if you look back to the 1990s, for example, on this chart, every point where the Fed stopped raising interest rates is highlighted by the vertical line. And in each case, you can see returns for both corporate bonds and muni bonds improved after that pause began. And so we think we're nearing a crucial pivot point by the Fed and for the fixed income returns going forward. Now, why might the Fed be able to pause and stop their current tightening cycle? One, supply side is improving. You saw a ton of disruption as shown on this chart. 50 and above shows some type of disruption for services and manufacturing. Delivery times lengthened significantly, and that's why you saw a huge spike on this chart in 2020, 2021, and into 2022. Delivery times didn't really start to normalize and get back to pre-COVID levels until the end of 2022. Now, on the demand side, you had a huge infusion of liquidity. Excess savings in the economy in the US went from around 1% pre-COVID to low teens, and that's gotten worked down pretty rapidly. So you have improved supply, less fodder for demand. And as a result, we think that the pressure on prices, whether it's housing, such as the National Rent Index, or other goods and services, should ease going through 2023, providing some flexibility for the Fed to exit the tightening phase in the monetary cycle. Now, they will have to confront some other factors on terms of, are we going to stay higher for longer? They have to ask themselves, are we going to have to cut? Whether it's the labor market, the policy lag of such huge tightening on the economy, China reopening and its impact on inflation, those type of factors will influence whether they stay at elevated rates or they start cutting like the market thinks the Fed might at the end of 2023. Now, how does that impact our strategy going forward, and how do we allocate your fixed income? So there's two components to the allocation. The first is the core allocation, and that is around 80+% of the allocation. And that the whole point of that part is to preserve your capital and produce income. And we hold bonds to maturity we're really overlaying two main thematic strategic looks on the market. I mean, one is duration, so the maturity that we're buying, and then quality. We're buying investment grade bonds, but within that tier of bonds, we're looking at the different levels in terms of are triple B minus or A plus more attractive. And these change within a cycle. So this time last year, end of January, you had the 5-year versus the 1-year on this table on the left have 91 basis point spread. So this was more significant than the 10-year versus the 5 years, all of which is a complicated way of saying the front end of the curve was steeper. So you're getting paid more incremental yield for every incremental year of maturity. Now, that made buying on the front end much more interesting to us at that time. Now, looking at where we are today in 2023, it's flipped. So the intermediate part of the curve is positive, whereas the front of the curve is negative. So for us, we're focused on the intermediate part of the interest rate curve. And on the quality side of things, we don't think it pays to go lower quality within the investment grade universe. The credit risk premium, or the yield spread between triple Bs and As, is at a cycle low. So we're trying to avoid triple B minus, triple B, prioritizing higher quality credits within the investment grade corporate bond universe. And so when you start looking at the second component of the fixed income allocation, it's really the tactical part, where you're looking at total return is attractive, along with low correlations with the core allocation. So it's being additive to the core allocation. And we're going to hold it opportunistically as long as the risk reward is compelling. And it's a whole wide range of subclasses that we could buy, some of which are listed here. The chart sort of features two of those available subclasses. One is convertibles in green, the other is high yield in red. And as the chart shows, valuations currently for convertibles is relatively attractive or relatively cheap, whereas high yield spreads are at the lower end of the historical range. And to us, particularly later in economic cycle after rapid tightening, we don't find that as compelling going forward. So when you start thinking about 2023, we think you have gone from a year in 2022 where there was huge upheaval in the market. We think 2023 will have somewhat calmer waters because some of the factors that were really driving the intense tightening by the Fed in the current tightening phase of monetary policy cycle are starting to ease, which could allow them to transition to a new phase, which is the pause phase. And that phase has historically been very supportive of forward returns for fixed income. That's especially the case now that you have yields reset to levels that are now above inflation, long-term normalized inflation levels, which wasn't the case before they embarked on this huge tightening cycle. So something positive has come out of a rough year in 2022. Now, the transition from tightening to pause won't necessarily be totally smooth, but we think during any type of movement up and down in the market, up and down in rates, that can create some really attractive opportunities for active management to create long-term value. Again, short-term volatility, long-term value, and that's what we're focused on going forward. Now, we really appreciate you taking the time to go through this presentation with us and to review fixed income. In the meantime, please look over the presentation disclosures as well as the glossary and index descriptions. And we appreciate your trust and your time. Thank you.